Okay, video number 2 for chapter 1. We're going to talk about GAAP. We're going to talk about some of the different characteristics of financial statements. This is kind of the basis for everything that you do in accounting, how the rules work. So most people think, you know, accountants, it's all about math, it's all about numbers, and it is about numbers a lot. But more than anything else, it's about organization and following a set of rules. It's almost like, yes, you're using numbers and you're using numbers all the time, but more than anything else, you're applying a set of rules so that everything is recorded in the right place and that anyone who reads a set of financial statements that you make, that you create those reports, will gather the same or similar information from it based on how you've recorded things. So GAAP is a set of rules that we follow, generally speaking, in accounting. So GAAP stands for Generally Accepted Accounting Principles. And this is our set of standards and principles and definitions about how things should be recorded within a financial system. Who sets these standards? FASB is one of the main groups that set them. FASB stands for Financial Accounting Standards Board. And their responsibility is to develop and change. These rules aren't, the same always. They change and evolve as our economy and our financial system evolves and changes. There's also an International Accounting Standards Board, which sets international policy. GAAP is a U.S. FASB, and GAAP are United States policies and rules. So major characteristics of financial statements. As I said, the primary goal of financial statements is to provide information that is useful in decision making. For that to happen, there's two things that have to occur. Number one, it has to be relevant information. Okay? That it has to be information that can be impactful in making a decision. And it has to have faithful representation. And that means that the information accurately reflects the entity's economic activity or condition. So, it has to be accurate, and we have to follow the methods and we have to follow the rules so that, like I said, whomever reads those, assuming they understand GAAP, can gather the same information from it. Next, a couple things that GAAP is also based on. A monetary unit. It says monetary unit. Well, in the United States, we're talking about the dollar, but if we're going international, it could be any number of monetary units. You could have euros or British pounds or Swiss francs or whatever the country is. But everything is recorded in monetary units. Everything is recorded in dollars and cents. Nothing would be recorded any other way, because that's the only way that we can accurately represent the financial information. Time period, extremely important. Whenever we make a set of financial statements, we have to state what the date is, and depending on the financial statement, we have to state the actually specific period of time that the statement is about. A business entity. This one is a big one that often gets confusing in accounting. So when we are talking about recording something, even if you're the only owner of the business and you're the sole owner of the business, we're recording information based on the company standpoint, and the business entity is separate from the individual. Even if you're just one person that owns it, it's separate from the individual. So for example, if I said I invested $20,000 in the business, that is an increase in cash. Now it's a decrease in cash to the person, the individual, but I'm not recording based on the individual, I'm recording based on the organization itself. So cash would increase in that case, not decrease, even though, if you're thinking about the personal finances of the individual, their money went down. The business's money that they have goes up. So everything we do is with regard to the business entity. The business entity is separate from the person. It's the organization itself is a separate business entity. And then going concern. So going concern is an assumption that requires financial reports to be prepared, assuming that the entity will continue operating into the future. So we're always creating a set of financial statements, assuming the company is going to be there next year and the year after and the year after. If they're not, then we would do things differently, but we always would assume as another assumption we make when we're creating a set of financial statements. Okay, principles. So we have those assumptions, and now we're going on to principles. The principles that we have for financial accounting are measurement, historical cost, revenue recognition, and expense recognition. The measurement principle determines that the amount will be recorded and reported, and it needs to be objective and verifiable. So I can't just make up a number as to what the value of something is. Now, there are times when we don't have readily available values where we'll have to make estimates that will occur. But generally, oftentimes we have a way to do that. So if I go out and buy a piece of equipment, it's really easy to see what it costs because I've got an invoice or I have some piece of paperwork and I know how much money I actually spent. So that's objective and verifiable. I can verify this is the money that I spent, this is what it cost me. I can verify that's true. I can't make a number up. So you wouldn't go buy a car for $10,000 and then record it in your book for 15 because you say the value of it's 15. What matters is that what you paid for it. Okay, that's how it goes on your books. We also record things at historical cost. So regardless of what we think the value is, regardless of what, regardless of, if we think it's, more or less, or if we have separate bids, the number that matters and how we record things in our books is how we actually record it in our books. Is what we actually paid for it. So the book has an example here of Aaron Publishers purchased the following building. It says the price listed was $160,000. Their initial offer was $140,000. They actually bought it for $150,000. 2 years later, the value was $220,000, and they assessed the value at the same time of $190,000. Well, all that really matters here, the only number we care about as far as recording in our books is the $150,000 because that is what I paid for it. That's a historical cost, and that's how it goes on my books. Okay, revenue. A lot of people mix up the word revenue and profit. I mentioned profit in the prior video. Profit is the difference between money that comes in and how much we spent. Revenue is the money that's coming in. So revenue is simply everything that comes in. So for example, Walmart, if you go buy something at Walmart for $10, that's all revenue, but it's not profit. Why? Because I got to take all the expenses, all the costs that came out of my pocket to make that money to find out what actual profit is. So revenue is just all of the money that I earn, all the money that comes in the business that is earned for whatever the business actually does. And revenue is recorded when it is earned, whether the money has been received or not. And this is kind of skipping ahead a little bit, but oftentimes I'll sell someone something and say, hey, you can pay me in 10 days or 15 days or 30 days. It's not an uncommon thing to happen. Matter of fact, it's a very, very common thing in business. It's called selling on account. But as soon as I ship that product, or as soon as I actually sell that product, even if I have not received the cash, I have earned that money, and therefore it should be recorded now. In service businesses would say I'm an IT person, I go out and fix someone's computer. And then I go, and then I send them an invoice and they pay me 2 or 3 weeks later. Well, as soon as I've actually gone out and done that work, as soon as I've gone out and actually fixed that computer, done what I was going to do, that is when that revenue is earned, and that is when that revenue is recorded. So as soon as that revenue is earned, it is recorded in our books. Expenses, the other side of the equation. Expenses are the costs and the amounts that we use to generate those revenues. These expenses need to match up to my revenues. So my example I just gave, if I go out and do IT work for someone, and I have completed the work, but I've not yet been paid, that revenue has been earned, therefore it should be recorded. In the same way, I want to match up any costs involved with that revenue. So the salary or the money that I'm paying that individual that went out and did the IT work, their salary or hourly rate, or however we're doing it, would be recorded at the same time as the revenue because they offset one another. Okay, expenses are money that I spend in order to make money, in order to create those revenues. It needs to match up to be in the same time period. So that is an expense as soon as it is incurred, and I earned revenue from that expense, okay, that salary. So I'd record it as soon as that happens. I'll stop the video here and we will go on. Next one will be the accounting equation.